The biggest myth is that once that property is bought from the developer, registered on the land titles office, that first registration makes the property used residential property. That is not the case. But in the example we're talking about, somebody is simply just flipping that property after taking the keys. GST is applicable on the full sale price of that subsequent sale.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Welcome back to the Tom Storey Show, your weekly real estate roundup podcast. Before we introduce today's guest and get into all the fun we're going to have today, I have a public service announcement because I think this is actually very, very important. For anybody that has an upcoming mortgage renewal, Steve, the mortgage renewal cliff is coming.
It's coming.
And nobody can requalify, and it's all horrid, and doom and gloom is on the way. But I just want all Canadians to know these 4 things as you go into your mortgage renewal. And in all seriousness, I think this could save you thousands of dollars. So the first one is when you get that letter in the mail from your bank with the rate that they want you to renew at, you don't have to accept that. So you can negotiate with them. And that might sound obvious. Steve's laughing, but like people don't know that. And they just go, this is the rate. I have to say yes. You can get a call with them, ask for a second opinion by other mortgage brokers. You do not have to take that first rate. The second thing, you can change lenders if you can get a lower rate. However, currently, Steve, why are you laughing at me? Currently, you would have to requalify if you're changing lenders. So if your financial situation has changed since you got that mortgage, you may want to stay at the same lender because you don't have to requalify. So there's things to keep in mind. If you would like to, on that renewal date, if you have the funds to do so, you could make a lump sum payment. I proudly, Stephen, just made a lump sum payment on my mortgage. It took 8 years off my amortization. 8 years. You see the amount of interest I'm saving from that one payment, Steve?
I'm just laughing because you're just talking about what you did this week.
Okay. So consider a lump sum payment if that is an option. If you have extra funds, think about it on renewal. Obviously, it'll make a big difference. And then this is probably the most important one. For the people that are coming up from a 2% rate and you're about to get a 5% rate, that's obviously not great news, right? Your payment's going to go up. Now, if you are really in a position that you don't want to sell your house, but you want to make this manageable for the short term, if you are 5 years into a 25-year amortization mortgage, that means you got 20 years left. Most banks and lenders will extend it back to the beginning. But big asterisks here, and like letting you know, that just means you pay way more interest over time and paying off your mortgage will take longer, but it could be a short-term solution to keep afloat. Steve, did I miss anything there?
No, I'm happy you sent me that statement. And it was, so Jimmy, just so you know, he did lump sum this week and he's like, holy crap, look how much interest it was like, I want to say it was something like 4 to 1 dollars in versus interest saved. Like it was a very, very, very high amount. So that is Tom just, not talking about his own personal situation, just discussing what's going on out there for you, the listeners. And
well, I didn't have a renewal, but like a lot of people are coming up to this, and the average Canadian doesn't know these 4 things. I really don't think they do. So I just want them to know. Enough about mortgage renewals.
Speaking of what average Canadians don't know, let's get to our guest.
Jimmy Le-Tang has joined the show. He's a CPA. He's a CA from Achieve CPA. You can check them out online. Also, apparently a friend of Steve. Still not really sure if Steve had other friends, but I like to meet them here on the podcast. What's going on, Jimmy? Welcome to the show.
Good morning. It's post-tax season for me. Thank you very much for having me on the show. I'm thrilled to be here. First time for me on the show as well. So I'm super excited. I want to say thank you for the invite. Hopefully I'll be able to add value to your time and your listeners' time today.
I think you absolutely will. We had told you before we started recording that we've actually never had an accountant on the show, which seems kind of crazy, but we're happy that you're here. And you also made us a promise before we started, right? That every listener will save millions of dollars based on the advice you give them today. Is that true?
Yeah, no, that's not going to be entirely true. I want to set the right expectations. Really, the name of the game nowadays, it's not about it's really about closing the floodgates on the taxes coming out. I mean, at all levels of government, be it municipal, provincial, federal, with all the changes. It's almost like a new announcement every 6 months or so about some sort of tax change that inevitably results in more money coming out of your pocket. So the idea is to really just slam the floodgates closed.
And I'd love to know like the conversations that you're having, obviously without giving us specifics about your clients, but when you're helping them with their taxes, with all the changes, like, is the average Canadian you're working with like saying to you, like, what the hell, man? Like, there's not that there should be loopholes or that we should try to find ways around the system or anything, but like the way the system is currently set up in Canada makes it very difficult to invest here, to grow wealth here. You know, we have our principal residence, which is, as of right now, knock on wood, we're okay when we sell that. We don't get taxed. Who knows in the future? You know, what are these conversations like with people?
Oh, the conversations are tough because every time I'm talking to my clients, it's always something about there's a new tax, there's a new thing, and it's more money out of their pocket. Even like more recently with the announcement of the capital gains inclusion rate change, it's now we're talking about if you're going to sell something anyways, then maybe do it sooner than you normally would, right? So there's an accelerated timeline. But if you are going to sell something anyways, I wouldn't suggest doing that, right? And then, Trudeau is talking about how the change in the capital gains inclusion rate is supposed to affect a very small percentage of the population. But, how many of us, at least in Vancouver, might have a secondary home? Maybe there's a family cottage somewhere. It's some random property that you don't really think of as an investment. But if you were to go to sell that, now you're subject to a higher tax rate. And never mind selling it. What about passing it on from one generation to the next generation? Now we're talking about another tax on a intergenerational wealth transfer. So, there's a lot of situations where people are affected by the change in the capital gains inclusion rate that I think the general population doesn't really see how it does affect them in everyday situations.
I remember going to this like small group event about a year ago, and they had an accountant there too, like a wealth manager type person that had the accountant beside them, and they were talking a lot about like, hey, listen, Canada spent a lot of money over the last few years, and they're going to find ways to claw it back. Like it's going to happen.
Oh, yeah.
And the generational passing down of wealth seemed to be one of the ways that they were saying, hey, it's clear that the government could come after this. So I don't know if there's any tips we could just talk about here, or perhaps surprises your clients have
let's
dealt
find
with.
out what that out what that looks like, though, because I do
Okay.
want to get a lot into the capital gains change because it's on everybody's mind lately. So how does the capital gains change then, Jimmy? So if let's say my parents bought a cottage in 1980 and they bought it for $50,000, and now for some reason it's worth $1 million. Parents pass away. I've had all my like my childhood memories are there. My cousins have all, like, the whole family uses it, but it transfers from my parents to me. Like,
All
what
right.
is the big change there? How it like I think I just inherited $1 million property, which my childhood and my memories are tied to, and I should have the right to continue that on to my kids in the future. But what are maybe some tax implications there that Canadians aren't understanding have come down and changed?
Yeah, absolutely. So you guys might see me looking down because I'm taking notes on the example that you want to utilize. So $1 million, and let's say the cost was $50,000. And I'm going to also throw in some additional assumptions as well too, which will simplify the example. So the main assumption is that because it's a cottage, a vacation property, the taxpayers, your parents in this example, are not going to utilize the principal residence exemption because they're utilizing that for some other property like their actual principal residence. And I point that out because not a lot of people know that vacation properties are eligible to be designated as a principal residence. So in fact, you could use your principal residence exemption on your vacation property. Maybe we can talk about that, a few minutes later on the road.
Okay. Yeah.
But the point being is that if you got a $950,000 capital gain, $1 million sale price, $50,000 cost, you have a capital gain of $950,000. So under the old rules, that $950,000 is subject to a 50% inclusion rate, meaning that half of the total capital gain will be included in the taxpayer's income for the year and taxed. So 950 divided by 2, you have a taxable capital gain of $475,000 for the year. Now, assuming we have a husband and wife combo there, so then really you're splitting that taxable capital gain between two people, and that will give you a taxable capital gain of $237,050, $237,500 each person. And if your parents are in the highest marginal tax bracket, which will help to simplify the example, then they're paying a tax rate of 53.5%. So you take that 237, multiply it by 53.5%, and their additional tax bill for the year is $127,000, right?
That's if
Under
they
the
try and
new rules,
sell it, though, right?
well, whether you sell it to a third party or you pass it down to the next generation, there isn't a tax deferral method for you to transfer property on a tax deferred basis to the next generation. So if your parents pass that property on to you, that is going to get taxed when you transfer that property over to you.
And you're the one, because you're the one that received this property, you're the one that pays the capital gains. Obviously,
No,
your
it'll be the
parents,
parents. It'll
even
be
if
the
they've
parents that pays the taxes.
on
Yeah.
the estate, even when they passed away.
Okay, so what we're on this example, they're still living, right?
Okay.
So
Okay.
yeah, they're still living.
Okay,
They're
so
just passing the property.
so let's do that. So one, you just calculated if they actually sold it to me, and that's its value, right? So
Yeah,
that was the old number you gave us, and then under,
yeah,
I don't want to sidetrack you here because I do want to talk about like if I received it through an estate,
yeah.
but so that was the old number. Now, what's the new number under this
What's the
new
new number?
rule?
So on that $950,000 capital gain, um, again, we're splitting that in half between the two parents, right? So each parent's going to have a $475,000 capital gain. The first 250 is still subject to the 50% inclusion rate. So that's 250 at the 50% inclusion rate. And then the remaining 475 minus the 250, that's 225,000 subject to the 2/3 inclusion rate. So that's 66.67. So of the $475,000 capital gain to each parent, the first 250 is subject to taxes on half of it. So that gives you 125 as a taxable capital gain on the first 250. And
Mhm.
then on the balance of 225, they're subject to a 2/3 inclusion rate. So that means $150,000 of that is taxable. When you add the two up, you have a taxable capital gain of $275,000 instead of the old rules where you would have only had a taxable capital gain of $237,000. So that translates to a difference of $38,000 of additional taxable income.
Can
Mhm.
I complicate this one step further? What if
Sure.
my parents, for whatever reason, because they talked to an accountant 10 years ago, transferred the property over to a corporation because they were renting it out once in a while and for liability reasons, or there's all these potential reasons why they would have done that. If they held it in a corp, does now all of it go to 66% because it was in a corp, or is it the day that they transferred it to the corp? You know, like maybe they did that 10 years ago, but they've owned it for 40 years.
Yeah, I hear you. So when you transfer the property to a corporation, to any other entity, that triggers a sale for income tax
Okay.
purposes, whether
Okay.
you receive money or not. And this kind of touches on to Steve's question earlier about, well, what if my parents, get the property to me, for example. For income tax purposes, it's a related party transaction subject to taxes at fair market value. So when the parents transferred the property 10 years ago to the corporation, whatever was the fair market value of the property at that time 10 years ago would have been the sale price, in air quotes. And your parents would have then had to report the capital gain up to that fair market value 10 years ago. That will then cause the taxes to be triggered 10 years ago up to that fair market value. Okay. And then the corporation will have a tax cost equal to that fair market value of 10 years ago. And now the corporation, if it actually sells the property or transfers it on to somebody else, that corporation will pay taxes on that appreciation in the value. And the corporations, they don't get the benefit of that 50% inclusion rate on the first 250. it's an entire inclusion rate of 2/3 on all the capital gain. So yeah, you just pay more taxes.
And so then, yeah, just to, for me more than anything, just to say this out loud. So if they owned it the entire time under a corporation, it's 66% on everything.
From the original cost. That's right.
Steve, that's what
Yeah.
your memories are worth at that childhood cottage.
Right.
66% tax.
But I don't think
Yeah.
that's likely going to happen as maybe it gets passed down. So if the person actually that owns it passes away and I inherit it, do I have to sell it in order to pay taxes? Does the
Yeah.
estate
So
gets taxed, or how does this work?
the estate will get taxed because when you have a death, right, there's a deemed disposition which triggers the realization of the capital gains up to the date of death, and that tax will be paid in the estate. So by the time the beneficiary receive the property or whatever, it's going to be on an after-tax basis with a new stepped-up cost, right? So a deemed disposition is a fancy word that the CRA uses to describe a situation where, despite there not being like a sale in the normal sense of the word, for
Yeah.
income tax purposes, there's a sale, right?
Mhm.
And that sale, because it's between related parties, will be at fair market value, whether any money changes hands or not. And there's a lot of situations where deemed dispositions occur. I mean, when you move out of a property to start renting it out, there's a deemed disposition there. A lot of people don't know that, right?
Yeah.
It gets them into a lot of issues there, right?
Crazy.
So
I feel like I'm
so
back
here's
in math
here's
class.
here's the question: can I inherit that property, or like what if there's no other money in the estate, for instance, and I'm just trying to get that property that I grew up in, and I thought I was just going to get it? Like, do I lose that now? Do I have to sell it in order for the estate to pay its taxes?
Well, the taxes are going to have to get paid one way or another. So if you have to sell assets within the estate to pay the taxes that arises, that is something that might need to be done. But then now we're talking about estate planning, right? So most people, well, I shouldn't say most people, but if you're fortunate enough to be thinking about estate planning, you would have a life insurance policy in place to cover things like your final obligations, right? And final obligations, a lot of people think of it in terms of like paying final like funeral costs, right? But no, it's not just funeral costs. It's also paying the taxes arising out of the deemed dispositions of your various assets, right? Now, if a person who dies had intended to sell the property anyways, like the beneficiaries, the kids or whatever, they have no use for the cottage, they have no use for that principal residence that the deceased has been living in, and they were planning on selling it anyways, then of course it won't be an issue because there will be cash to pay the taxes. But in some cases, if we're talking about a generational transfer of a sentimental property, well, you're not going to have cash to pay the taxes arising out of that deemed disposition. So you better have some cash somewhere else, like a life insurance policy, or just downright out of the savings of the estate. Some people might have RRSPs or other life savings that they're in the form of cash that they can utilize then to pay those taxes right before the property transfers over.
Okay, so most of this is probably an issue that most people are not going to have, right? So I'd like to shift, thinking about the capital gains inclusion. There's a greater chance that more of our listeners might have investment properties, investment condos, and particularly, I'm getting a lot of questions these days. I think there are people watching YouTube videos out of the States where they're trying to put properties into LLCs to try and limit their, like, we don't even technically have the same thing here, right?
No, we
As an
don't. Yeah.
LLC. Um, with this change, is it even smart to own any of your properties in a corporation anymore, or did this change just screw that tax plan for everybody that owns, say, 3, 4, 5 units in
Yeah.
a corporation's name?
Hey agents, a clean and easy to manage real estate website is a must. Go to realtyninja.com/Tom right now and start your site totally for free and pay nothing until you launch. And then when it is your time to go live, you will save 20% off of your entire first year just for signing up at realtyninja.com/Tom.
Yeah, Steve, you bring up a very good question. I get these questions all the time about, investors asking, should they own their real estate investments through a private corporation? So on your personal tax return, all of your income is taxed at you, whatever is your marginal tax bracket is. Like there's no differentiation between investment income, which is typically passive income, versus active income such as employment or self-employment. Okay. But in a corporation, there are differences. So active business income is privileged income in the sense that you get that taxed at a small business deduction tax rate. So in BC, the low rate tax for an active business corporation is 11%. It's 11% because there is a 17% discount on something called a small business deduction. And that small business deduction discount is only available on active business income. Whereas investment income doesn't have that discount. Investment income doesn't have some other discounts in there as well either. And in fact, investment income in a private corporation has a premium tax attached to it called the refundable tax, where the corporation would be prepaying a certain amount of tax that they will get back when they flow dividends to the shareholders and move that tax up into the shareholders' hands. So in a private corporation, the tax rates are significantly higher, specifically at 50 and 2/3% for aggregate investment income, which includes interest income from like private mortgages, for example, dividend income from stocks that are not from connected corporations. So if you own, let's say, RBC stock, BMO stock, I don't know, whatever Canadian corporation, Bell, for example, that pays dividends, those Canadian corporations are not connected corporations. So you're not going to, you'll be paying a higher tax rate on that. And rent is included in there as well. Capital gains on investment assets are also included in there. So investment income in a private corporation is taxed at a rate of 50 and 2/3%. So what I usually say to my clients is there usually needs to be some other reason why you would want to have that real estate asset held in a private corporation. And that reason is not going to be for tax savings because you're not going to save any tax.
What would that
And
reason be?
well, maybe for example, if the money was if the down payment came from a private corporation where the tax rate was only 11%, that
Sure.
is one of the scenarios where you might want to have a corporation own that real estate asset. There's a couple of other technicalities in there, but I guess for brevity, I'll skip that for now unless you really want to dive into the details of that. And then other reasons why you might have a property in a private corporation would be for maybe creditor protection, estate planning issues. But all of those considerations have nothing to do with tax. It's kind of like these other benefits for having it in a private corporation outweigh the disadvantage or pitfall of paying a higher rate of tax on whatever is this income stream. So, the investment tax rate on your rental income every single year. And then when you eventually sell it, the investment tax rate on the capital gain. And of course, the capital gain inclusion rate for corporations is 2/3 and not 50%, right? So it was never really a good idea to have passive investments in that corporation. Now it's just, less of a good idea.
It's even worse,
Yeah.
basically, at this
It's
point. You're
worse.
just
Yeah, it's even
yeah.
worse.
Okay.
Yeah, that's exactly it. It's worse.
So
So
is
if
it
I'm
still like it's kind of always been like, if it's 4, 5, 6 properties, now we have a corporation. If it's 1 or 2
Yeah.
condos, it's in your personal name. Maybe that's even shifting the other way because you're probably not going to sell all 4 of your lifetime condos in the same year, right? So
Yeah.
like just for the tax benefit, you're saying personal might actually be a better way to go if that's the only consideration.
Yeah, and sometimes, Steve, like people have already maxed out on their credit worthiness, I suppose, like debt servicing ratios personally.
Mhm.
So, if you wanted to get that next mortgage, for example, and your lender says, you know what, like for whatever reason, we can get you a mortgage if you were like a corporation, all right? So that's an example of some other reason why you would want to have it in a corporation, and it has nothing to do with tax savings because you're not saving the taxes, right? But if you want to get that mortgage, you got to have that property in under the corporation. So that's another reason why you might have it under the corp, knowing that you're paying higher taxes.
Jimmy, without getting into details about how much money you have invested and where, as an accountant, do you believe in real estate? Do you invest in real estate, or where do you put your money?
Oh my goodness, that's a great question, Tom. As a self-employed person, I run an accounting practice with my partners here. My money honestly goes back into the accounting practice in terms of investing in more staff, investing in more expertise, and broadening our offering as an accounting firm. So at present, at least, yeah, the whatever extra money I've got does go back into the business. From an investment perspective, I've got my RSPs, I've got my education savings plans. From a real estate perspective, I tend to view real estate as another asset class, right? No different than stocks, bonds, mutual funds, etc. So I try not to have everything in the same basket, right? If I view real estate as an investment, the home that I'm living in right now is, I guess, an investment as well too. But because I'm living in there, it's less of an investment, more like a roof over the top of my head, right? So if I had some extra money, would I invest in real estate? I definitely would, but I would look at that more of a broader perspective in terms of what is my asset mix already.
Right. And when I guess a few months ago we had Steve Suretsky on, and he was talking about some of his clients that were doctors, and when this new capital gains inclusion rate went up, they were very livid, and there's all these Facebook groups. So if you were to sell your accounting practice one day, that is a corporation, are you now being dinged at 66?
Well, and that depends on what I'm selling. If I'm selling the shares of my corporation, I still have access to things like the lifetime capital gains inclusion. The lifetime capital gains exemption,
Okay.
right? And that applies to any small business corporation. There are some very restrictive qualifying criteria to ensure that you are a qualified small business corporation. So if you got a business and you're selling your shares, you still have that access that available to you. But if you are, if you're selling your business and it doesn't qualify under the qualified small business corporation shares, and you do have a capital gain, then I am paying more taxes on it, right? So, there's definitely more taxes to be paid, but you could always structure your business in a way to minimize.
Just asking for a friend. If I sold, if someone were to sell
Good start.
their PREC, does that count under the lifetime exemption?
So your PREC is an active business corporation. And there's other criteria there, like you got to make sure that you're operational in Canada. All of your assets are, working towards active business in Canada. And so if you could sell your shares, then yes, potentially you would be privy to the lifetime capital gains exemption, which, by the way, is now up to $1.25 million. So you could sell qualified small business corporation shares for $1.25 million and walk away tax-free with that. But the reality too, though, is certain businesses lends itself to, not being very separable from the person who runs the business, right? So like, for example, as an accounting practice, as maybe a real estate agent, a doctor, sometimes like that business is very attached to you as an individual. And it's very difficult to sell that business as a unit, as a sellable unit, discrete from you as an individual. So in other words, if I'm a doctor, right? I mean, I've got a license to practice. I mean, I could just start up my own practice, right? Why would I need to buy somebody else's practice? Unless, of course, it's a type of practice where I want that book of business too, right? So there are definitely merits to that, but it's not going to be the case all the time where a service-based business is going to be able to separate itself from the person who runs that business, right?
And just for clarity, a PREC is a PREC, a personal real estate corporation, which, by the way, Jimmy, I didn't even tell you, I'm in Ontario. I'm in Toronto. We only got those in 2020. Thank goodness we got them.
Oh my God, it's an amazing thing.
I was just getting dinged before that. So when Steve says PREC, he's not actually trying to call me a different word.
I get that a lot. Yeah.
But we're
Yeah.
so restricted with our corporations.
There's not much
right?
you can do
Yeah.
with it, but it is still better. It's better to have it than not to have it. I'll tell you that.
Yeah.
Some years.
You're right. You're right.
You know what I found? This is Jimmy. I'm gonna poke fun because I know you can take it. I found as soon as I started my prec, I found all the tax savings that I got went to Jimmy. So he's my accountant. So now I'm just keeping Jimmy employed instead of sending that money to Justin Trudeau. So thank you very much.
Oh, you're welcome. Thank you for helping me out, and I appreciate the support. Absolutely.
I think I just spat on my mic there. I'm sorry.
Yeah. Okay, so let's get into some of these potential topics that I know Steve really wants us to touch on. Steve, why don't you start with number one, this possible new principal residence tax, and explain this to me.
So I was reading an article. My Mrs. Karrasch sent me an article and was like, "This is the next proposed tax." So I was reading through it, and there's a think tank that is being, I guess, explored with the federal Liberals. Maybe they're going to try and jam it down our throats before they get ousted, of a new principal residence equity tax, which sounds fantastic if you don't own a home or if you don't have much equity in your home. The thought is that every home valued over $1 million throughout the entire country should have a federal annual tax applied to it. Now people are getting this confused because they're thinking, oh, they're going to come after our capital gains on our principal residence, which I think they will also come after because they're trying to get that money back, right? But I think there are rumblings out there that you're going to start seeing things possibly like federal. It's almost like a federal property tax for
It is.
the wealth.
I was going to say exactly the same thing.
So, don't worry, it's only going to affect
0.00%.
No, 12%. 12% of the
Well,
population.
if it's 12%, then it's really 40%,
But how would you even pay that, right? I don't know what the tax rate would be. Let's say it's 1% of your assessed value, and you're a little old lady that owns, for no fault of your own, an $8 million property on the west side of Vancouver. You're screwed. You're selling your property to pay your federal tax.
Yep.
Or I'm sure there'll be an exemption or some sort of deferral. There'll probably be a deferral, actually. So we just save that money later on or something like that. But it's like you mentioned at the beginning, Jimmy, like, how many more of these types of taxes can we think about implementing? And then what are the likelihood from your point of view that they are going to continue to just claw these things away from us?
Well, I like to think of it in terms of, if you think about the government as a business, the last several years during COVID, they've just been dishing out money, right? Dishing out money for support payments of various different levels, individual level, business level. There's various monies going out. And of course, that's it over and above their budget for other things like capital improvements and everything else. The point being is that for the last 5 years, all the government's doing is been paying money out. And now they're trying to get that money back, right? So I'm not surprised that, there's a think tank out there thinking, they're going to tax the equity in somebody's principal residence. Steve, I agree with you. There already is a tax, and it's called a property tax every year. And I already do hear about stories of little old ladies who cannot afford to pay their annual property tax based on what it already is. And then if you factor in that it's a secondary property for some of these people, maybe whatever. But the point is they might already have a deferral in place for their property taxes. Now, if you tack on another federal level type of property tax and you allow for a deferral, what's there really left for the beneficiaries of the estate, right? Nothing.
I was
which
always
is the whole
curious
point.
why when I've done a few estates this year, Steve. I know you're pretty active selling them as well. I was always wondering, like, I didn't push them on it, but I was like, why aren't you just keeping this in the family? This is a great property in a great area.
For tenant, landlord, or homeowner insurance policies, go to squareone.ca/the Tom Storey Show. Use the link in the description. Save $20 when you start your free quote right now.
Based on this conversation today, I'm kind of figuring out, well, they just want to clean their hands and move on and pay the tax. And, if there's 4 siblings and one of them is maybe not as agreeable as the others and needs the money, it's like it creates this whole thing where it's just like, okay, fine, let's just sell it and move on.
That's probably because there is 2 or 3 or 4 siblings. I
Yeah.
think that's actually going to change, Tom, when we have mostly families that are only having single children now. Another generation down the road, right? When my kids, if they don't have friends that have brothers and sisters, they're probably going to they might keep that home because they might inherit a $2 million property that's paying them $4,000, that could pay them $4,000, $8,000 a month in rent or whatever the number is, right? So that could happen as we could continue to have less and less kids, because usually estates, man, when almost all the time I see estates and there's like 4 kids and 3 of them are totally wonderful, normal, lovely people.
And then there's a Steve.
And then no. And then there is the one kid which could just not piece it together. They just couldn't put it, and they're looking for that money. And they're usually the one that lives in some rural property somewhere, and they're like, oh, I'm going to inherit my portion of the $1 billion property out of Vancouver. So that's usually why I think they end up not converting them into rentals. And let's face it, a lot of those people probably just aren't interested in rental properties. They haven't been their whole life, so they're probably not going to be now. It's just easier to sell the property and move on and never have to talk to your siblings again. Right?
Jimmy, before we go in more in depth on all the points we've got here, I just like your opinion on this. So, when the capital gains change seemed to be like create all this discussion where it's like, well, why would people want to invest in Canada, want to grow their business in Canada? We have a lack of doctors in Canada. We need more, and you're creating a system that's pushing them potentially outwards. We had people comment on our video, Steve, saying, I'm a doctor and I left, and here's why.
I've had clients that have done that.
Is it getting to the point, like, don't we kind of have to be open for business? Why are we making it so aggressively the other direction when we know we need people to be more productive? And I'll be the first one to say we don't need more real estate agents. We got me and Steve. That's all we need for Canada. But it's a long question. I do this a lot on the show. But like, just general thoughts on that. Are people telling you that? Your clients like, I'm getting out of here. Why? What's the point?
Yeah, I do have people that are leaving. And on a more kind of granular level, I've got clients that are leaving BC to go to Alberta. So I'm seeing a lot of that. Even my own friends, right? Like my high school buddies, they've all moved to Alberta. And then if I expand into my business network, I am seeing clients leaving Canada altogether. Some of them are going back home where they were originally from. Some of them are just moving to another country just to try it out. There's lots of reasons why people would leave. And yeah, like taxes and the cost of living is one of them. It's unfortunate, but I suppose that's the message that the government is really, putting out here, is that, with all these additional layers of taxes, they're not really open for business. And, investment capital is moving outside of Canada. And when you have investment capital leaving, it causes a knock-on effect to the rest of the local economy, right? Like even on for example, real estate transactions. Yeah, I mean, properties may be overpriced or underpriced, whatever the case may be. But if there's no transactions, if nobody's buying or selling, that means nobody's buying new appliances when they move to a new place. Nobody's doing those cosmetic renovations when they're moving to a new place. Nobody's hiring movers, right? Nobody's hiring these different trades that they need help with. And that has a serious knock-on effect to the rest of the economy. And that's what I'm seeing is people are just getting overtaxed, right?
And is there any chatter in the accounting world? I'm guessing you guys have a secret society and you meet underground somewhere with all the heads of all the companies. If there's a shift in government in 2025, is there a hunch that something might be pulled back, something might be changed, or this is just what it is, and even if the government changes, nothing's happening?
Well, I mean, from what I've seen historically before is the present day government never wants to be the one that puts in the new tax. And the opposition party is always going to decry those taxes. But I wouldn't be surprised if the opposition, once they are in, then it's like, well, we're already stuck with this tax and it wasn't us that put it in. Yeah. They're not going to want to take that away, right? I mean, I think that's the reality, is that you can talk all you want when you're the opposition. But now if you do become the government and you've already inherited, this source of tax revenue that the previous government had already put in, and they're now out because of it, you're just going to probably keep it.
I got to pay for all his mistakes, man. We can't take
Yeah.
that. We can't take that out. We got to keep that one here now because that guy was so bad for so long.
Steve, at least they all have their pensions, so they're all good.
Yeah, I heard about that one too.
There's one guy that doesn't have his pension yet.
Not yet, but he'll get it. He'll get it.
He is definitely getting his.
They literally moved the election by a week.
Yeah. I mean, you know what? That's funny because there's so much conflict of interest there. How could they even do that? I mean, it doesn't make any sense, but whatever. I digress.
Yeah, there's so many topics we can go to there. Can you, I don't know if you're versed on this or not, provincial and federal here in BC, provincial and then federal flipping taxes? Is this?
Yeah.
How does this get done twice now? Like, I'm wondering if there's a flipping tax and one of them is like 20% or something here in BC. I don't know what the federal one is. I think it's income tax, basically. Is there any profit left, even if I wanted to try to do it? Like, is it double tax? I don't get it.
Yeah. So I want to kind of go into a little more detail about how the taxes are implemented, because the federal one is a little bit of a misnomer because, the federal anti-flipping tax, although they call it the federal anti-flipping tax, it's not really an additional tax in the sense of a separate tax. It's the deemed treatment of what that taxable amount would be. So normally you would have a capital gain. And as we talked earlier in the podcast, the capital gain is subject to a 50% inclusion rate below 250 for individuals, and then 2/3 inclusion rate for anything above that. So if a property is caught under the federal anti-flipping tax rules, it deems that property to be sold on account of a business activity. So instead of getting that 50% inclusion rate or the 2/3 inclusion rate, the entire profit margin, the lift, if you will, that would be taxed at your full tax rate. So 100% of the lift would be taxable. Did you guys follow what I mean there?
Yep.
So I basically what you're saying is if it's a capital gain, it's an investment over a long period of time, and people were trying to say, hey, it was a capital gain in a short period of time. So they've basically changed that to say, okay, now it's not a capital gain at all. It's actually business activity. So this is basically income tax instead of a capital gain.
That's right. So in a capital transaction, you would be paying taxes on half of the capital gain. In a business activity, you pay taxes on the entire lift, right? Yeah. So that's what the federal flipping tax does, is it deems that sale to be on account of business income and not on account of capital gain, okay? Mm-hmm. So that's the federal anti-flipping tax. The provincial one, the BC one, is more like a levy. Like it really is a tax in the true sense of the word, because it is a 20% tax on your profit margin, right? And on top of that, it's not something that you would disclose on your normal tax return. So the federal anti-flipping tax, you would need to report that as part of your tax return. The BC anti-flipping tax is a separate return. Think of it kind of like a property transfer tax return. Mm-hmm. So with a property transfer tax return, you pay that when you buy the property, and you have to fill out a separate property transfer tax return. Well, the BC anti-flipping tax is similar like that. It is a separate return from your regular income tax return that you would normally do. And because it is a separate return, it is something that you would need to do a lot sooner, right? So I hear, and I think it is 90 days post-closing. So 90 days you've got to then fill out this different tax return and pay your money. And then, of course, when you get to the end of the year, you still have to pay personal income taxes on, your profit margin, your lift. And I don't know yet if that tax, that levy, will be
counts as an expense,
right?
As I don't know if it's going to be counted as a deduction yet. I have to look into that part. But the funny thing is, actually, it's not funny, but the reality too is that at both levels of government, provincial and federal, you'll see that they make an announcement, and there's an effective date. And yet nobody really knows how it's going to work. Like they're almost like kind of making it up as they go along. Like look at what happened with the federal underused housing tax, right? I mean, it was applicable to a lot more people, and then they scaled it back. Look at the federal requirement for the reporting of bare trusts returns, right? They implemented that, and then at the 11th hour, they scaled it all back, right? So literally, like this is the same thing happening with the BC anti-flipping tax. They make this announcement, and then they make up the rules and the legislation as they go along, right?
Yeah.
So
I found that to be quite, actually, the first time I ever saw it, I found it to be absolutely disgusting, which I find a lot about the BC NDP these days. So I guess my main channel's been pointing that out quite a bit. But when they proposed and then implemented and voted in the cooling off period for BC, the law that they put in, literally the law that they read into law, actually said to be announced. So they passed the law. They could have changed that to anything. They could have changed that to, whatever they wanted, but it was passed to be announced. And I'm like, how can you're passing a law now where you haven't even written the law. Nobody's reviewed it. You've just said, we are putting this in. And it seems like that's now the way you can pass laws. You can just pass the idea, and then the fine details, don't worry about those. It'll
come out
later on. And then the final details are, oh, by the way, it's also 100% tax. And you're like, wait, that's not what you said earlier. Yeah, but don't worry about that.
The final details depends on the backlash that we get.
Yeah,
totally.
That's true.
Totally. But I made a point of like, okay, how are they going to get this in legislation? Like, you're going to say that a buyer has a right to back out of a contract. Like, how are we actually going to do this? So I read it, and it literally said to be determined at a later date. And I'm like, wait, what? And they're like, yeah, voted through last Friday. I'm like, I don't even understand how laws can be passed this way, but they can. What else do we got, Tom? We have vacancy taxes.
We'll get to vacancy tax. Okay, Jim, here's what I want to ask you. Okay, I'm going to come from this from a real estate perspective, and you can get as political or not political as you want to go with this. But so I'm looking at this. So real estate's been very good to me working in this career, working in Toronto, and generally I love Canada. Okay, so let's just make that clear. But if I'm looking at like opportunities to build my wealth, be an entrepreneur, and this is my real estate example, but many people listening will have their example in whatever they do. I would say, okay, well, wow, Airbnb became this great thing. Now I can make additional money at the house that I live at, or I can buy an investment property. Well, that was basically slashed and gone. Well, okay, I can buy properties in corporations, and for specific reasons that would make more sense to me. Well, now I'm just paying more tax on it, right? We could go down the life insurance conversation with business owners and corporations, and that alone will hurt my own head to try to get into that with you. And then you're saying like, okay, fine, we're paying all this taxes, but we just as Canadians just want to make sure like we feel like we're getting back what we're doing, because you're making it so difficult for people to actually be entrepreneurial. Like it's very difficult with all these changes. What do we do? Do we just take it?
Real estate agents across Ontario are using Tressa Video to increase trust and transparency with their clients. And now for a limited time, you can get your own custom branded video totally for free. It's simple, and here's how it works. Simply refer your broker of record to tressavideo.ca, and when they purchase the broker version for your entire office, tell them to enter the promo code SUMMER at checkout. That's right. Refer tressavideo.ca to your broker of record and get your own custom branded individual or team video totally for free. Refer Tressa Video to your broker of record, and they will love you for helping them provide value to their agents. Your coworkers will also love you because now they'll get use of Tressa Video for their business, and you will love receiving your very own custom branded Tressa Video totally for free. So tell the powers that be at your office to go to tressavideo.ca and enter the promo code SUMMER at checkout. This offer is valid once per brokerage purchase and for a limited time.
Because I'm not going to move to the States. It's not that easy. My family's here. I'm staying here. Like, are your clients kind of fed up too? Just saying like, well, what gives? There's nothing that can be done now. Where should I be spending my time? Do I just go, okay, fine, I'll just give up?
Yeah, great question. And, I think about it in terms of, what's my next best alternative, right? In any sort of negotiation, if you know the other side's, next best alternative, then you can plan your course of action based on that. But for me, what is my next best alternative? It's not like I can just pick up and move somewhere else. I've got a business here. I've got a team of staff members here that depend on me. I've got my family who are well rooted here. I can't just pick up my family and move, to somewhere else, right? Even to the United States. Like it for me to move is a big deal. Even to move to Calgary, like my buddies are all saying, Jimmy, come to Calgary. It's not that easy. So what is really my next best alternative? And I feel like in some ways the government realizes or knows, or they are betting on the fact that your next best alternative is no other alternative.
Yeah.
So you're just going to sit here and take it.
Yeah, I guess that's just kind of the sad reality. And you were saying before, when you're saying it's kind of funny and then you stopped yourself, like all these things have gotten to the point where we kind of just have to laugh. Other words, you're going to cry about it. It's like everything's a little bit funny with what's going on, because you just gotten to the point where it's like, I'm working so hard. I'm running my own business. I employ people. Steve employs people. You employ people. And it just feels like it's like, well, sometimes you work so hard, you have your best year ever, and then you pay your taxes, and you're like, wait, what was the point in working all those extra hours? Did my quality of life become better? Well, no, it was worse because I was away from my family, and then I just paid more taxes. And what I think I'm at least personally getting back from those taxes doesn't seem to line up at least with what our expectations maybe were in the past versus now.
Yeah, absolutely. There's just a lot of taxes all around, right?
Well, I guess. Okay, so
but it's keeping you employed,
Speaking of
Jimmy. That's the
taxes.
part. It's keeping Jimmy employed. He loves it.
It does. You know what? Like honestly, it's one of those things where, like lately at least, I feel like I'm constantly the bearer of bad news. Like there's a large proportion of my client base where every time I talk to them, it is some form of bad news. Like it's not good news. Like it's just. Actually, I got some good news this morning in the sense that we defended a client from a CRA secondary review on their vehicle expenses that they deducted in their corporation, and we won that one, right? So but it's just like those are small wins in the bigger picture of a bunch of losses that the government constantly dishes out in the form of new taxes, higher tax rates, like. Going back to 2018, like tax on split income, and they were curtailing the ways that business owners were paying spouses, for example, right? I mean, that really curtailed the opportunities of income splitting. There's a whole bunch of different things that they had done over the past 5 years, 10 years, right?
What about the idea? I've never got to ask you this question. What about the idea of just like with every new layer of this, there's just so much more for you guys to do, like just scaling back on taxes would reduce that. Like I think of that with every time they implement one of these new buyer protections here in BC, it's another 4 pages of paperwork I need to do. I was just talking to a guy that in one of my offices here. He's been around since the 80s, and he's always done 10 to 20 deals a year. Like he's made a good living off of selling real estate. And he's like, I can't do as much business. Now he's an individual guy, doesn't have an assistant, doesn't want this big business, just wants to help friends, family, referrals. That's it. And he's like, I just can't physically do the amount of transactions anymore. So what are my options? Maybe he retires because he's older, but maybe he has to charge more because he can't physically make as much by doing more transactions. You must be in almost like a similar boat. Like, are you really going to make us learn 17 new taxes? You didn't change the old tax. You implemented another 150 things I have to learn this year to help my clients that I was already working with. That must be just a pain in the ass.
Well, practitioners are leaving the profession, right? And there was an article that I read, I think in the Globe and Mail not too long ago, and they were talking about how with tax regulations changing constantly nowadays, more so than ever, that as a practitioner, your potential liability is so much higher now that you have to keep on top of all these rules, regulations, and even from beyond the tax regulation, from an industry regulation as well too. We're all regulated by CPA BC, and then of course by extension the the national organization of CPA Canada. So we have to follow all these rules and regulations that it becomes so much work for an individual practitioner to stay on top of, that it really does become like a sense of survival. Like, in order for you to survive, you have to get strength in numbers, right? And just be part of a larger team, have a larger support network, so that you can kind of divide and conquer. As partners, we're able to leverage each other and help each other. But as an individual person, it's very, very difficult to stay on top of all the rule changes. And of course, talking to our clients about, all the various different tax issues and whatever. Some practitioners are just deciding, what, I was going to retire 5 years down the road. Maybe I'll just take early retirement now, right?
You know what, Tom? It sounds like a real estate team, hey? It's like,
It does.
it sounds a lot like that. It sounds like, man, we gotta team up or we're getting absolutely slaughtered. We're coming close to the end here, but I was going to ask about vacancy taxes, but we can maybe save that, Tom, for another time, because they affect so few people. Income taxes on rentals I wanted to talk about, but here's the one I want clarity on, because I think most agents don't understand this, and definitely condo flippers of pre-sales don't understand this. GST applicable on the second time the property sells. Most people think, oh no, I completed on that. I completed from the developer myself. I paid the GST. GST is paid. Come and buy my condo. GST is included in the price. Don't go buy that one down the street where GST is still on top. Clarify for me. What's going on, Jimmy?
Oh, Steve, it's such a big issue. And I run seminars on this all the time with real estate brokerages and talking about GST issues on various different types of transactions. But when it comes to pre-sales, right, historically, there was a bit of a discretion as to whether or not GST would apply on an assignment of a pre-sale agreement. So that discretion is now gone. The federal government has said that for all assignments of pre-sale contracts, GST applies. GST applies on the lift, not on the refund of deposits, okay? So I know that's not exactly the example that you're talking about, so I'm going to circle back to your example now, where somebody has a pre-sale agreement, they don't assign it, they close on that purchase, and they get the keys. They obviously pay the GST to the developer because it's new residential property, and they don't occupy it. So they're not living in it in themselves. They're not renting it out to somebody else. Maybe it was somebody who is in it from an investment perspective. Maybe they wanted to assign it, but for one reason or another, couldn't assign it before completion. So now they've got their keys. They turn around and relist it for sale. The question then becomes, is GST applicable on that subsequent sale price? And the answer is unequivocally, without a doubt, yes, it does. It always has, and people just don't know it. And then that's where they get into trouble, because it is the seller's responsibility to collect and remit GST to the CRA. It is also the seller's responsibility to notify the buyer that GST is applicable on the transaction. And a lot of times what we find out is that nobody says anything about GST. The buyer assumes it's used residential property. They're not paying GST. And at the 11th hour, either the seller is trying to collect an additional 5% on top of the purchase price, which the buyer says, heck, no way, I don't have another 5%. Or the seller is just going to be like, oh, you know what? Like, I really need this to close. I'm just going to swallow the bullet on that 5% and say the GST is in there. But now they're cutting a check to the CRA for that 5%. So let's now circle back to the mechanics of all that, okay? So GST, we know, is paid to the developer at the time of the original purchase. The buyer then becomes the next seller. And because they are flipping this property, right? The property is not occupied either by themselves or occupied by a tenant. It is, in effect, new residential property, okay? So we have to understand that new residential property has always been subject to GST. It's just that not all people realize that it's still new residential property. The biggest myth is that once that property is bought and registered by the first owner, bought from the developer, registered on the land titles office, that first registration makes the property used residential property. That is not the case, right? that does not make the property used residential property. A property is used residential property when somebody occupies it as their primary place of residence, rents it out to somebody else who occupies it as a primary place of residence. That makes it a used residential property and therefore becomes GST exempt on a subsequent sale. But in the example we're talking about, somebody is simply just flipping that property after taking the keys. So it is subject to GST on that subsequent sale. GST is applicable on the full sale price of that subsequent sale. It is the seller's responsibility to notify the buyer that GST is applicable on that full sale price. And if they're selling the property for $1 million, the seller needs to collect $1,050,000 being, the GST on top. And then that $50,000 goes to the CRA. Now, a lot of people think, well, that's double taxation, isn't it? Because the seller, the first buyer who then becomes a seller, paid GST first to the developer and then collects GST again from the next buyer. It's not double GST because what many people don't know is that the seller has the ability to get a GST number because they're running a business now, right? Mm-hmm. Flipping a property is running a business, even if it's only a one transaction business. They could register for a GST number. And when they register for that GST number and they file their GST return, they can claim a refund, a credit, if you would, on the GST that was originally paid to the developer. And then they would offset that against the GST that they collected from the next buyer and only remit the difference to the CRA. So let's put some numbers to this. Let's say, for example, the pre-sale contract is at $800,000 purchase price. So GST on top would be $40,000. So when the time comes for the first buyer to purchase from the developer, it's $840,000, $40,000 of which, of course, is the GST that they paid. And if they're selling to the next buyer for $1 million, they're going to collect $50,000 of GST from the next buyer. Well, when the first buyer, who now is our second, or who now is our seller, files their GST return, they're going to report $50,000 of GST collected from that next buyer, minus the $40,000 of GST that they paid to the developer, and there's a net difference of $10,000. You would send that net difference to the CRA. So you can see that the CRA is only getting GST on the stepped up value of the property. So that's how
you need a GST number to do that, right? Like are you going to go file for a GST number after when you realize, oh crap, or do you have to do it originally?
So if you want to make life easy on yourself, you get a GST number prior to the closing date of the subsequent sale. That's making life easy for yourself. If you didn't get the right advice, maybe you're working with the wrong realtor, they didn't tell you that there's an issue here, go talk to your accountant kind of thing, then you didn't know, right? So then now the closing date for the subsequent sale is gone and done. So you can still get that money back that you claimed that you paid on the GST to the developer, but now you have to go do it in a runaround way where you have to first send the $50,000 to the CRA. So there's a cash outflow of $50,000. And then on a separate application, you have to apply for a refund of the other $40,000. So there's a difference in cash flow timing there between doing it the easy way versus, going about it the hard way, right? The end result is still the same. Right?
Yeah. No, I love that. That's fantastic. Like Tom, this is the type of amazing information you can get from listening to the Tom Storey Show, as opposed to like the Canadian Real Estate Show, which would just be garbage by now. So
or listening to some other YouTube influencer who,
they're another channel. Apparently they post sometime on Sundays, but don't worry, don't look at them.
Hold on, just one question from my end on all of that. That's BC. We have HST in Ontario. There's lots of Ontario listeners. Do we want to complicate this even more? Okay, so same rules.
Same rules, because GST or HST in some provinces is a federal level tax, right? So it's the same rules that apply across Canada, just different tax rates. So in Ontario, it's 13%. So you can see the stakes are even higher in Ontario, right? Yeah. The stakes are even higher.
And I'll say, correct me if I'm wrong, because I probably am, Jimmy. So if you don't do any of that, you as the second seller owe the tax again, and it's going to be a big problem, and there's maybe no flow through or whatever there is. But at the same time, if the CRA, and this has happened in a couple of times, can't collect from the seller, guess who they go after?
Oh,
They will
I don't know
actually
about that
go
part.
after the buy. Oh no,
Yeah.
it's been done. It's been done. It's been done. It was particularly in this case. It was, the seller was offshore.
Yeah, so in a non-resident situation, which is a whole different ballgame, and by the way, I also deal with a lot of non-resident tax issues too. So if you're looking for information on non-resident tax issues as it applies to real estate, like I'm totally your guy. But yeah, when you are dealing with a non-resident seller and a non-resident seller does not fulfill their tax obligations to the Canadian government, then the Canadian government will go after the resident Canadian buyer. So yeah, it does apply and only to non-resident transactions.
And that would then include the capital gain from that.
Yeah, capital gains, GST, whatever, right? Rental income tax, whatever, right? I mean, at the end of the day, the sections under the Income Tax Act that pertains to obligations as it applies to non-residents, the Tax Act is written such in the perspective of the last Canadian payer. So the last Canadian payer is typically the buyer, right? And you as a buyer, you are required to exercise reasonable inquiry to determine if you are buying from a non-resident. And if you are, you as the buyer are obligated to fulfill certain things under the Income Tax Act. But it's usually the seller that goes and does it. So the seller goes and does those things, but they're doing that at the behest of the buyer, because if the buyer fails to get the seller to do it and the taxes aren't paid, the buyer is ultimately on the hook for the non-resident taxes.
Well, I woke up in a good mood today. Yeah, I'm not so sure. Hey, Jimmy, final question, most important question of the podcast. Let's say I get a call from a Rolex AD and I can buy a Daytona at retail and I sell it in a year. Am I going to get dinged on the 20 grand I made on the sale?
Well, first of all, you're never going to get another Rolex from that AD. That's one. I should point that out. Second,
I would not do that, to be clear. I would not do that.
If you are selling that would be on account of income from property, like capital property.
Yeah.
So technically speaking, that would be a capital gain. But how many casual Rolex, sellers are actually reporting the taxes on the sale of
many.
Every single one of them. Every single one.
Of course.
For sure.
Every single one of them.
Well,
Tom,
when I come out
with...
Yeah,
no,
I was just going to say, when I come out west next, Jimmy, let's hang out. We can nerd out about watches. Steve can bring some scotch or something. It'll be fun.
Amazing.
Okay. Steve,
Tom, I want to wrap up. I found a quote. I love my quotes. Sir Winston Churchill this time. Ready for this? I wonder if Jimmy knows this one because he's in the tax world. Sir Winston Churchill. I don't know if I'm not going to do an impersonation. Never mind. Because he uses the word, he says, I contend, and nobody would ever say that now. I contend that for a nation to try to tax itself into prosperity is like a man standing in a bucket trying to lift himself up from the handle.
I saw that somewhere recently, and I thought it was very insightful.
It is our current state.
I always wonder if these quotes were actual quotes or if they're just new ones made up, putting a famous person's name beside them.
Taxation's been a real bitch for many years, man. America was founded because of taxation. They were like, screw that king guy. We're going to go do our own thing. So that's death and taxes, man. It's the only certainties.
Jimmy, for people that are listening to the show or watching this episode on YouTube, what's the best way for them to reach out to you? Obviously know what you're talking about. There's a lot of people that could use your help. And I'm sure maybe your fees went up a little bit because you have to explain a bit more to people these days, but it is worth it. Obviously, Steve pays you. How do they reach out?
Give me a website.
achievecpa.ca. You can find me there.
All right, let's go there.
Perfect. Thank you, everybody, for watching, listening to this week's episode. Thank you, Jimmy, for joining us. Thanks, Steve, for being here, and have a great week, and we will see you next week. Bye.
Awesome. That was great.
Okay, one sec, Jimmy. I'm just going to...